What's up? Good morning. Come televo, Jumbo, my friend. Hey now. Guten Morgen. How are you doing today? Please respond to the poll that I have posted. Welcome to Forex.Today, the YouTube community of just about 20,000 foreign exchange traders. Let me remind you that trading is risky, not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results. Please stay small, stay humble, focus on the long term, never risk money you cannot afford to lose. My name is Wayne. I'm a currency trader just like you. I've been doing this almost 20 years. So ask questions. I'm here to share. I'll be your guide on this thing we call Forex. This is a no cost to you monetarily live stream. However, there are things that are required. There is a cost to attending these live streams. The first one is you take notes. You don't just ask random questions, but you ask thoughtful questions. You take notes and you document those notes in the comments section below the recording of today's video. Therefore, you can search all your comments and find very specific videos that were helpful to you. And I also recommend time stamping them, so you could just imagine like 3 years from now, you can just skip to that part that you found interesting today. And so you can customize your journey here at Forex.Today. The second cost, the obligation coming with this no monetary requirement live stream, is that you visit tradersway.com, open up a demo account, give them a shot to earn your loyalty and respect. That's pretty simple. But I highly recommend you work with a broker that you trust. Traders Way has earned my loyalty and respect through their actions and through their business ethics, and therefore I recommend them to you. Tradersway.com. I posted a poll here. Hopefully you've answered. While you do that, I just want to point out this pattern here. Okay. The interesting thing about that is that's the normal pattern for this pound Swissy currency pair. Tickety boo. What it also says is that pattern is probably done for now. We have a false rally for a month and then probably down again, which is kind of interesting. Why is that over there? Yeah, it's weird, right? Let's do this. I don't remember where these are. What? My number's locked, isn't it? What? No keyboard today or what? Number lock? Huh. All right. Maybe I don't have a keyboard. That's all right. I don't need a keyboard to live stream. All right, we'll just leave it at that. So I just thought that was interesting, and I was in the process of looking back in time to see if something similar has happened in the past. And then I'm like, oh my God, I got a live stream. So what do we have here? Basically middle of February down to middle of March. So we got to go back to February the previous year. Where am I? September, October, August, June, April. Yeah, some opposite. Now, last year was opposite in many cases. So anyways, let's just get off that and let's just move on.com. I was just doing research. That's all. I guess that's the message. Yeah, I actually spent time doing research. Okay, let's take a look at the poll. We have statistically relevant data. Let's end that. Survey says most people are interested in euro. Okay. CAD, pound, and Aussie. Very few people interested in Aussie. And some people interested in CAD. Okay, so now I'm going to make some assumptions. And maybe it fits what you were thinking, or maybe it don't none. I guess we can start with Aussie because nobody statistically is interested in Aussie. I'm not sure why. Maybe it's overbought already. Okay, maybe. But right now, the plan is still sort of working. We got to make another higher high. And target is about 74 on the short run. If you're thinking more than a couple of months, okay. Okay, let's say if you're thinking more than 1 month, let's say 2 or 3 months, your target wouldn't be 74, would it? Your target would be, that's probably the April target. Maybe, what is this? Maybe June? I mean, the ultimate target would be 80, right? You're buying it at 71, 72, and you're now 73, but your target is 80. I don't know. Maybe. We'll see about what happens and, as you rise. Time of year and reasonality is important as well as seasonality. So it's interesting that you guys are not interested in Aussie. So, I mean, we're not really in a medium in which we could have a conversation. Like, why are you not interested in that? So the counter of that, like, you're not interested in Aussie, but you are interested in euro. I would assume here that you're selling euro. Okay. Right? It has negative interest rates. The rest of the world is raising interest rates. Yeah, well, I imagine, Johnny, people that are in the day trading group probably are more open-minded to Aussie based on my discussion of industrial metals. Okay. Cool. So euro, huh? So you guys are into euro. Okay. So my discussion with euro last night was basically this for the day trade. You lost your euro dollar trade. Why would you lose your euro dollar trade? All right, you took this role reversal. Well, let's break that down into smaller digestible pieces. So you would have sold it around this price, but why are you out already? Help me out, Argo. James Paul says RBA interest rate decision tonight. Yeah, but what decision? We already know they are not raising interest rates until wage growth is above 3%, and they're nowhere near that. So it's sort of like, what are you going to tell me that I don't know already? Right, Jimmy? Right, JP? Pope James Paul? Arco, are you with me, man? Walk me through it. Where's your sell? Arco. Oh, Arco. Yeah, well, there's two ways that newer traders protect themselves from loss, because you have to remember, amateur traders are trading with fear. So they either have super tight stops, which means they can only lose a little bit at a time, which means there's nearly 100% chance you're going to get stopped out. Because a newer trader, look, their entries are just not that good. So if you have a super tight stop, 99% of the time you're going to get knocked out. Now, the interesting thing with that psychology too is if you get knocked out a lot for a loss, even if it's a small loss, as soon as you get a winner, you want to get out of the winner because it's going to pay for your losers. And of course, that's like the dumbest strategy you could possibly have. Now, the second thing is you get sick of that, and then you have super wide stops or even no stops. And also that don't make any sense, right? So now you have big losses and little winners. So that doesn't make sense, okay? But look, assuming you shorted here, or actually it would have been here. Assuming you shorted there, your stop should be above here. Okay? So you shouldn't be knocked out already. Okay? You see that hourly 21? It's in the game. Well, ARCO, support and resistance, is always the easy answer. Okay? So, okay, this is a role reversal trade. I'm assuming you took that. This is a moving average trade. Right? That's the other rationale for your sell. Okay? We box it like this. So there's two trades here. Plan A, Plan B. So your stop would protect either of those. And your stop would be above resistance. Where's resistance? Well, at the very least, let's connect this area here. Okay, so now your stop would be, I don't know, here. Just throwing it out, food for thought. So this is your risk zone. Okay. Let's get rid of some of this old analysis. Another way of using as a guide for stop placement is you can use your PSAR. Let's make this one bright red. Okay. So let's say you sold A or B. Okay. PSAR is suggesting that your stop is right here. Let me get my drawing tool. Okay, this is where PSAR says your stop should be. Oh my God, that's where I said it should be. Okay, I said here, but whatever. Okay, so how about that? PSAR. I don't know where to put my stop, Wayne. How about right there? Why? Okay. Now that's adjusting your stop based on volatility. Do not use parabolic stop and reverse as an entry. If you listen to a guru that tells you that's how you use PSAR, stop listening to that guru. They think they know what they're making, because it makes sense when you think about it. When you oh, well, that makes sense, stop and reverse. So if we're, a change of the PSAR means go the opposite way. No, it does not. No. And they'll say, oh, look, this shows you this and this shows you that. No, it's so late that it doesn't actually work out. So instead of having an algorithm tell you to buy, which is redonkulous, okay? Algorithms are not created to make decisions for you. If you can't make decision, you're not going to be worth much money. You're worth less than someone that can make decisions. Think about who gets paid money in this industry. People that can make decisions or people that cannot make decisions. Okay? So instead, if you've decided to sell, this is different. You decided to sell this, okay, because you had a trade plan. Then once you've sold it, then you use PSAR and put your stop right there. Okay? And this is your risk down here. Okay? And of course, down here is reward. Cool, right on, Arco. Well, Arco, my advice to you, since you are beautifully young, do not try to make money. That's so short-sighted. And I know I can say it's childish. And you're like, I'm not a child, I'm 17. Just whoa. Just settle down. I want you to look at this like you're building a business empire. I want you to think long game. I want you to think like you're 27. I laugh because, to a lot of people, that's young. I want you to think bigger. I want you to think like you're in the middle of you're just starting university, and that you're going to spend years of deep study with the goal of building a business around your education that will last an absolute lifetime and will probably change generations of your family. Or you try to get rich quick, whatever, dude. Your call. Cool. So there we are. We're in the trade. Nice little role reversal. Okay. Cool. So that's nice. It could last a couple weeks or not. Okay. We have a high print here. Okay. Current low print on the open. We'll see what happens. Now I'm hoping for risk on today. I'm looking for the stock market to go up. Okay. So I'm looking for QQQ to have a +2 kind of day. Have you guys been watching the 10-year T-note? That's been amazing, huh? Why don't we take a look at 10-year T-note? Okay, go out maybe a month. We were at 2.05 and we dropped down to let's just say 1.75. 30 basis points drop, which means money has come out of the stock market and into the bond market, raising bond prices, dropping yield. But that has to do with the fear of a fear of, what's going on with Russia and the Ukraine. It's another way of being parked in cash. Now, I have a theory, and I explained it in great detail to, I think, both the day trading group and the swing trading group. I tried to share as much as I can in both groups, but, the day trading group meets 10 times a week. So a lot gets covered. But nonetheless, just sort of based on behavioral finance around profit taking in January and reinvestment, reallocation, and rotation by the end of the first quarter. So it'd be nice if we can kind of get back, back to 2.0 and above. Risk 1% per trade. Is that where my stop should be? No, that's dumb. Sorry, Richard. I'm not saying you're dumb. Making a decision based on how much you want to lose is a terrible idea. Doesn't make any sense. The market doesn't see your trade, doesn't see your account size, and doesn't give it a damn about your 1% loss. Besides, your 1% loss could be 25 pips away. I don't know your lot size. So it's completely irrelevant. Okay? So Richard, your stop is based on support and resistance. Okay? The same as your entry. Your entry is based on support and resistance. Your exits, whether it's for a profit or a loss, is based on support and resistance. Everything is about support and resistance. So if I bought it here, for example, my stop's either lower than that or lower than that. Okay, so let's say this is my plan. Okay, the pink arrow is my plan. Oops. I was going to clean this up a little bit. So my stop is either here or here. So let me clarify why. Okay, let me do this in yellow. If I'm long based on this swing, my stop is below that swing. It's fairly short term. Okay, or it could be based on the lowest low because I really want to stay in this trend. Because we could be stuck in here for a while, and I'm okay with that. So maybe it does this, but I made my trade not based on the bottom of the trend or the range, but instead of this 3A2 Fibonacci retracement into the longer term uptrend. Okay, so you bought this candle, and so you either make the decision A or B, and your stop is either right? Either here or here. Now, okay, now, Roger, we take a look at this, or sorry, Richard. Okay, going back to Richard's question. Which one do you want? Okay, one is basically a swing trade, one is basically a position trade. Okay, so if you go B, the only way you can lose money is to be 100% absolutely ridiculously wrong. It would have to roll over and fall for a month. The other one would be at least short-term wrong, where it would have to fall for like an entire week or so, and disastrously wrong. Okay, cool. So let's say you pick B. Your entry is here, your stop is here, you calculate the number of pips. It could be 100, it could be 300, whatever. Okay? And what you can say is, let's say it's 300 pips. No, that's too much. Let's say it's 100 pips. Okay? And then you would say, Richard, I want this 100 pips to equal 1%. So now you calculate what lot size do you need to place on this trade, so if it totally collapses in 2 or 3 weeks from now, you're knocked out with a losing 100 pip trade, that is no more than 1%. My guess is you're over leveraged, and that'd be way more than 1%. So you're doing it, your calculations are like really backwards. Because you're like, well, I only risk 1% on a trade. Well, that's meaningless to me. It doesn't make any sense. It's meaningless. It's gobbledygook. We risk pips, not percentage, and the risk is based on lot size. So instead, you would use technical analysis and say, well, you think there's only, let's say, a 15% chance this is going to drop all the way down and knock you out at stop loss B. Okay? But that distance is 100 pips. You do your calculation. Let's say it's 1 mini lot. Okay? 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 1 mini lot. And then you get the dollar value, right? My guess is you're not trading like that, and that's too far away. You're like, Wayne, oh my God, 100 pips worth 1%? Well, what it is you're over leveraged. I'm not suggesting you need a 100 pip trade, stop loss. What I'm suggesting is you identify support and resistance, identify how many pips that is, and do your calculation. But dude, if your stop is, let's say, 25 pips away and you're risking 1%, it's sickening. Like, honestly, it makes me sick to my stomach to think that you would do that. Okay? For me to lose 1%, I need to lose about 20 trades in a row. Times 33 pips. Now, you're going to look at me and say, whoa, you're way under leveraged. Maybe. Okay? So maybe I'm the ridiculous one that's unbelievably conservative. But then on the other side of that argument, you have to admit that you're ridiculously over leveraged. Now, I don't know if you are, Richard, or not, but listen to the argument. And of course, I'm speaking not just to you, Richard, I'm speaking to the aggregate viewer. If I'm ridiculously under leveraged, most people here are probably ridiculously over leveraged. What's the difference? Maybe I got more money. Maybe, I don't know. But the psychology changes. When you got nothing to lose, people take risk. It's a human, well, I should say at least in the Western world through Western psychology, the study of Western psychology. I don't know about other cultures. But hey, the Chinese people that I know love to gamble, so it's probably universal. But when you got little to lose, you risk it all. And when you got a lot to lose, you risk none. You defend. Okay? But I'm telling you though, if using the idea of like, instead of talking about money, let's just say poker, right? Your stack of chips. If you don't have a big stack, okay, that's just me not talking about money. Now I'm talking about money, but nonetheless, I want you to trade, think, act, right, as if you do have a lot of money. Because for many of you, especially going to ARCO, who's just maybe starting a career in professional foreign exchange trading and management, oh my God, right? You should be trading as if you do have a lot of money, because one day you will trade on behalf of people that have a lot of money. You have skills managing a lot of money. They don't have the skills, so they hire you. And they're like, Arco, let's just make up a number. Marco, here's $1 million. Okay? We'll pay you 2% management fee to cover your regulatory costs, and you can keep 20% of the profits. Now you're in business. You're providing value through a service of money management, but also to entice them to invest, you'll have to have a good understanding of macroeconomics, central banking policy, global money flow, so that you can talk intelligently. So you can say things like, there's a Australian, let's say Reserve Bank of Australia is meeting today to discuss and announce their interest rate policy in Australia, but you've already studied the data and the research going back many months in Australia. And that Governor Lowe and his team have already stated that the economy is improving, is stabilizing, but they're not considering interest rate hikes until wage growth is above 3%. And you're like, oh, wow. Okay, like think about first of all, I'm thinking about interest rates. Many retail traders are not. Also, that comes across like, I've actually done some work. I've actually done some work. Therefore, almost by definition now, I am not an amateur. I know stuff. That makes me an expert. I have expertise, okay? And then I can get very specific in that and say they are not raising interest rates until wage growth is over 3%. And now I can go and look at that. And as we approach that, I can also talk to those potential clients and say, oh, well, it looks like we're getting close to that 3% wage growth number. So maybe in the next 6 months, we expect the Reserve Bank of Australia to start raising interest rates, and we want to start front running that. Okay. Right now, I'm buying Aussie dollar not because of interest rates, but for demand for industrial metals. Why? I don't know. Why don't you join one of my paid groups and I'll tell you why. Can't have everything for free, baby. Okay? Okay? Yeah. All right. So Richard says, yeah, okay. So I determine my trade size and yeah, okay, good. You're getting it. Awesome. Awesome. Okay. One of the things I've been teaching since 2005, okay, the number one goal as a trader is capital preservation. That's the number one goal. If every decision you made was based on how do I preserve my capital, you will survive the long run. Now think about this. Think about your trading ability right now. And if you could survive 5 years, you're trading every single day for 5 years, but you're not just throwing down trades. You're studying technical analysis. You're developing patience. You're developing discipline. You're developing some real skills. You're learning about fundamentals. You're learning about seasonality. You're learning about monetary policy. 5 years from now, you're going to be way, way, way better of a trader than you are now. So stop thinking about getting rich quick, trading big. Stop thinking about it. Imagine how much better you will be in 5 years if you learned all those things I just mentioned. And then wouldn't you just be better trading bigger lot sizes then than now? And in fact, especially if you're not that consistently profitable now, why would you be trading big now when you're generally not very good? So at least, number one, preserve your capital so that 5 years from now you still have capital. Yes, Richard, you have to think of $5,000 as $1 million. Yes. Okay, look, Richard, if you can do 2% a month, sometimes, let's say, and in the best months, let's say 5%. Okay? In fact, let's just cut it all the way down. Let's say you just average 2% per month. You are the best professional trader trading Forex in the United States. Okay? I think there's probably, according to Barclays Hedge database of commodity trading advisors that focus on global macro, there's probably 5 traders that, right, that do that. So, based on leverage size, people are going for 20%, which is just dumb, right? Okay, so reverse engineer everything. Okay, and by the way, just so you get a sense of it, 2% a month is not 24% a year. It's closer to 33. 5% a month is about doubling your account every year. So 3% a month average, you're about 50% a year. Now, it might be 44, maybe it's 52. But think of it that way. If you can average 3% a month, you're probably getting 50% a year. 50%. Meanwhile, on average, the S&P 500 over a long period of time averages 8%. So you don't need to make 50% to attract capital. In fact, a lot of people look at that suspiciously and say, well, risk-adjusted performance will probably tell me that you're doing that from taking undue risk. People are not interested in risk, so they don't even look at your results. Why? They're too good. So you can lower your leverage even more and say, wow, let's double it. Let's say the S&P 500 produces 10%, okay? And you produce 30%. And based on risk-adjusted performance, you're outperforming the S&P 500, but not through additional risk. You will have no problem, if you can do that over long periods of time, you'll have no problem attracting capital. And if you just trade normally day in and day out, the secret sauce to your success is not getting bigger and bigger returns. Instead, you'll focus on assets under management. Okay? Okay? And every year you get more clients and it gets bigger and bigger and bigger. And 30 years from now, you'll have a nice business. You'll have several employees to help with all the paperwork and the management and all this. And you'll go to conferences and do speeches. You'll write for magazines. You'll talk on TV. and you'll oversee a small team of traders that are fulfilling your strategy, and you'll have a very nice life. You'll drive a nice car, you'll live in a good neighborhood, and you'll sleep in a comfortable bed. Okay? And you'll probably die a rich person unless you have 3 or 4 spouses through your lifetime, and then you'll die broke. Cool. Okay, we're still stuck in the range here on the open. Okay, currently not a risk on mode, not a risk on mode, not a risk. Well, this one's trying to pop up, but it's 4 hour. It's actually hanging in there. Aussie giving back some that it's gained. So still currently some risk off on the open. This is my kitty cat. So I got this one. I'm doing this one to the downside. I don't quite remember my entry, but I'm pretty sure it was off that central pivot. So that one is still working out, which is fine. Well, Greg says, that you could be doing really big per day. That is true. I'm just teaching that you don't need to, Greg. Instead, I'd rather you have much smaller ambitions and have much longer term goals. Okay. Now, Greg, right in the beginning, you may have to have maybe a higher level of risk to kind of build your account. But the logic there I often disagree with, because you're taking higher risk in the beginning with the idea that later on you will reduce your risk. But of course, that really generally doesn't happen. And also you're taking higher risk with poor likely performance based on skill level. So like, would you recommend to someone to take more risk when they're not that good versus less risk when they're really good? But really what I think kills it is people do not reduce their risk because they're making really good money in the beginning. So they throw out all the advice and they continue trading big. But then what happens is the math points to a point of a bust. Like you're big, you're big, you're big, you're big, you're big, you're big, you're broke. And I'm trying to prevent that crash. I don't want the bubble to burst. So anyways, but I get what you're saying. I'm not disagreeing with you. I just disagree on the idea of it. So like, I guess to add one more, if you made 100 pips a day because you're trading really well, the only difference between having that be 0.25% or 2.5% or 25%. The only difference is leverage. So I'm okay like people developing the skills to have better trades and let the winners run so that they're thinking, triple digits or quad digits, right? I preach 333 pips on swings and stuff like that, right? Okay, yeah, I like this. This is what I'm going for. 100 pips or more on trades, yes. But I would not pitch that return should be 25 pips. I would preach the return would be 0.25 pips. Okay. But but it's the same trades. The only difference is the leverage. So anyways, let's go back to this CAD. Let's do a deeper dive. Okay. Now you can see my plan was up and then down on these. I just took it anyways. I think 2 days ago, in fact. I can never remember if it was Sunday night or Monday night. Man, it feels like like currency trading week is just one long day. So, and I'm always trading different time zones. So last night, we met in the day trading group and I'm like, is it Tuesday? Is it Tuesday? Because I'm thinking, like, I think that it's Wednesday because I'm trading Asia, which is Wednesday in Asia. So I don't think like today that it's Tuesday because in my mind, I'm sitting at my desk and it's already Wednesday. Now, my butt is in Tuesday, but my brain is in Wednesday. Okay. So anyways. So this is really based on a seasonal trade. Okay. So like I could be looking at it this way. So I got, let's say, my dollar trade for now, and if it don't work none, I could retool that, right? But now I could look at Kiwi yen, or sorry, Kiwi pound, Kiwi CAD, please, if I may. So like we can switch this up and say pivot points monthly, for example. I wish these had watermarks. Which ones have watermarks? Let's do, I can do position trading bearish bias, a little better. Okay. So I could say this is a selling price based on market, and then this is a selling price somewhat based on price. So you might have it listed here as one, you know, sort of an Alamo, second chance move, and then this one is the current, okay? And here's the, right? Here's my thought process on this. And you can agree with me, you can disagree with me. You're not going to hurt my feelings unless you insult me and then I kick you out. Right? All right. I could start with this idea, and I'm not looking at Kiwi at all, by the way. I'm just looking at CAD. So if I decided that I wanted to buy CAD across the board, basically build a basket of CAD trades, I already got one USD CAD short, so I got one in the bag. Done. And my belief is it's strong, let's say, for 4 months, 120 days, minimum 100 days. Cool. So now I drop into this and say, do I have an opportunity? And again, I'm not really looking at Kiwi. I'm just like, okay, CAD versus everything, right? So I can say, well, if this is a lower high, at some point it'll make a lower low, lower high again, right? And I get short here for a minimum 100 days. Huh. What do you think about that? Okay, that's really thinking in advance, isn't it? Okay, I can show you another one. Again, food for thought. You still need technical analysis to enter this, right? Here's one that we were revisiting here. Okay? So I say to you, this is going to fall 100 days at least. Cool. You can see it's definitely going in favor of CAD, okay, based on demand for oil. No, it's not Thursday yet. It'll be Thursday soon. Still Wednesday. In my mind, because the markets are not open in Asia. Okay. So, would you find it interesting if I told you that this is a normal move on this pair? Okay. And this is a normal move on this pair? No, AM, Arco. Okay, this is early. I would expect that more like, let's say, the end of March, not the beginning of March. But that's my model, if you want to think about it that way. I am thinking down, but that's unusually normal, or unusually soon for the model. But there's a standard deviation to any model, right? So I'll pick a number. I'll just say, in the model, I might say March 15th, be prepared to sell EuroCAD, but it could be as much as March 1st or March 31st, right? And let's say that there's a standard deviation that by the end of March, you're selling this. And so this year it happened here, which is unusual, but still inside of a normal distribution. So you got a left tail. Usually it's here, but it could be any one of these per year. It could be any one of these dates, right? So it's still within tolerance. And then you'd say, well, how do you explain this? Why did it move early this year? And it had everything to do with CAD, okay, with high oil prices. And Europe, okay, now in a situation, not only are they vulnerable with the Russian situation, but because of that situation, can never raise rates. There was a glimpse of hope for a millisecond that they might normalize back to zero, but even that's probably off the table now for at least a year. So whatever hope there was, there's no more hope. Okay. And of course, Germany could have addressed this problem 25 years ago, but they didn't, and now they're being punished. Okay. So whatever. So this moved a little early, but okay. It's neat to know that this move here is usually followed something like this and then down 2 weeks from now. That would be the normal model. So I call that model a framework or a lens. I look at all these charts through a lens, and in a scenario like this, I'd be looking for, I think it's going to go up. 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 You see the double bottom, higher high, higher low. You're long there, and you're done. Johnny Rocket. This technical analysis confirms the model, confirms the opportunity, confirms the thesis. Okay? Think about by writing a paper. Okay? When you write a paper, in here, you state your thesis, and it should be clear. In this paper, I will show evidence through analysis of 25 years of price action that EuroCAD will go up in January, let's say. Okay? And we will look at paragraph number 1. Okay? Data point. Paragraph number 2. Data point. Paragraph number 3. Data point. Paragraph number 4. Counterpoint. And number 5, summary. Okay? This confirms. This is a confirming point. Right at the right time gives you a reversal pattern. And of course, the argument is the reversal pattern formed because there's a logical reason for this to go up this time of year. What's the logical reason? Well, maybe that's tougher to prove because there might be many variables going on here. Okay? Because there's many variables in regards to euro, there's many variables against on CAD. Okay? And then you combine them together. But what you'll notice, if you're able to do that, if you're able to thread the needle, like you're looking for a double bottom before the double bottom is even formed, and then you get a double bottom, you take it. Well, it's one of the two things. It's either magic, okay, which is kind of cool because, you know, you can demand gold and jewels and diamonds and virgins and everybody in the village brings you these things. Otherwise, you cast your black magic on them. Okay? Or it's logic. If it's logic, you can find that through research and you can plan accordingly because you have a level of understanding. I like to think that all of this is business logic and there's logical reasons for it. I believe the universe works on Newtonian physics. That this is a giant machine of Forex and the stock markets and the bond markets, right? That they're the commodity market. I believe that they're all cogs in a giant machine. Okay? For example, if oil goes up, this goes down. Oil up, this goes down. Okay? Why? Europe has to import its energy. Costs them more money. Where does the money go? Oil producing countries that sell their oil to Europe. High oil prices push this down. Okay? One way of looking at it. So they're related. Okay? Right now, CAD is getting strong, and I want to corner the market on kitty CAD. Okay? Cool thing is, on Sunday night, I broke it down. My idea for CAD, for example, I broke it down not using fundamental, let's say, analysis or technical analysis. I explained it basically through a story of how things work in our economy. And I started in December and worked my way back to March and then ended with the conclusion of, oh, I should buy CAD. Why should I buy CAD? Based on how the next 9 months work. No, Arcos is 1-for-1. My swing trades and my position trades are usually 10-to-1. That gives me an excellent Sharpe ratio in times of trend. First quarter, okay, and third quarter are not trending, in most cases anyways, or actually you could argue they're counter trend. But anyways, let's say long-term trend, first quarter and third quarter are perform less good, okay, for a trend trader, because there's just lack of trend and even some counter trend. Okay. Second quarter, fourth quarter are great for trend traders and stuff. So in a normal thing, in a normal sort of trending market, when you got global macro on your side, yeah, 10-to-1 is not unusual at all. Okay, in a higher volatile, lower trend market, I'm going to perform less well, and my targets need to come in and my stops need to go out. So, you know, it's tough. Maybe it drops from 10-to-1 to 2-to-1. Okay? Depending on how volatile. Okay? This year we have the volatility, which is normal in Q1, but we also have now like an exogenous shock going on, as well as dealing with the change in monetary policy in the United States, and in fact in almost every central bank in the world. So there's a level of complexity which will kill the trend. Okay? But I have strong convictions for the next 4 or 5 weeks. I have very strong convictions for some of the markets. And so, right, I'm trying to tiptoe in. So let's say, I'll just say this one. I don't know if I have strong conviction or not. That's not for me to tell you. But let's say I did for Kitty CAD. Then my aim is to buy CAD versus all of these. Okay? 1, 2, 3, 4, 5. Okay? Now, if I put 2 mini lots on each one of these and I have $100,000 in the account in cash, that would mean I would have $100,000 invested into this market, buying CAD. So I have 1x. I have 100,000 in cash and 100,000 in the market, which means I only have 1% in the market, right? So because of leverage. So anyways, I could then set up a goal if right? And this keeps you kind of interested if you want to gamify what we do. But again, now you have to have a bigger understanding. You have to have a much bigger understanding than 99% of people listening to this stream. Because you need to be able to predict the future the next 90 to 120 days in advance. Well, if you can't do that, then shoot, you can't do jack. Okay? So if I had that, right, that thesis, now I'm confirming everything with technical analysis. Okay? And of course, if I get opportunities, I get opportunities. I take the trade, I drop a stop, I got the risk, everything's fine. But I might say, over the next 90 days, I want to get this to 5x. How do I do that? 5 trades on this one, right? 5 trades on this one, 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 5 trades on this one. Is that enough? That's 50K, 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 50K. No, it's not enough. Or is it? No, it is enough. It is enough, right? What did I say? 5x? No, because I got to get to 500. Okay? That's only $250,000 position, but remember, I have $100,000 in cash. So over the course of 10 weeks, I basically got to get 1 or 2 trades a week. Well, you know that can be done, right? Okay? You see how you can slowly build that up? Okay? 5x is a big position, isn't it? You're like, that's 100,000 here, 100,000 here, 100,000 here, 100,000 here, 100,000 here, and you only have 100,000 in the account. That's how you get to 5x. That's 50 trades. Okay? But over 120 days, okay? Like think of it in 1 week. Okay? 1 week, you could probably get 10 trades per week. Okay? So anyways, at least it's a goal where you're not focusing on how much money you're making. You're focusing instead of getting good additional entries and managing your stops. And then what you'll find is even if you're not successful getting 5x, but you're successful at getting 2.5x, that means you have 25 open trades that are running somewhere between, let's say on average, let's say you do a lot of this in the beginning of the move. Let's say on the average hold is, let's say out of 12 to 14 weeks, let's say 8 weeks. 25 trades you're holding on average for 8 weeks. Some are 12 weeks, some are 6 weeks. Okay? But they average out how many pips is each trade worth? On average, if the average is 8 weeks, 500 pips each? Okay? 12,500 pips. There's the logic. I'm just throwing out logic. I really want you to think about this. Can you day trade your way into 12,500 pips profit? Probably not. Now, of course, it takes 3 months to get there. 8 weeks is only 2 months, but let's say it's a total of 3 months. So you got to break that down. But I bet you 1,000 pips a week is better than most day traders. Most day traders are focused on money, and they're like, I made $1,000 this week. How many pips did you make? 100. 100. That's one pissy day trade. A swing trade, it would be embarrassing to only make 100 pips on a swing trade. So therefore, the day traders that made $1,000 are way over leveraged, and statistically speaking, they're just as likely to lose the $1,000 than make it. So in the long run, they're uninvestable. The other thing is, if they make their 100 pips and then they disappear, there's no compounding, they're not letting it run very far, all that kind of stuff. So you can never, right, this is based on compounding. You understand? Every single trade has, let's say, a fixed amount of risk. Let's say every trade you take, the biggest risk is 50 pips. But on average, you're now averaging 500 pips on the win side. But you can't take additional trades until the first one stop is at break even. So every week, maybe add 2 or 3 or 4 or 5, right? I think we're saying 5 trades a week. You got 5 different pairs. It's 1 trade per week on each pair. And you make a trade, and then you're eventually able to move your stop to break even. And then now you're ready for the next week. And you got no risk. So therefore, okay, now you're risking the 50 pips again. But on week 2, your upside now is more like 1,000 pips, because now you got 2 trades, but you're only risking 1 stop at negative 50. The earlier trade is at break even, but you're going for 1,000 pips on these, right? So anyways, no matter what, you're still thinking 10 to 1. Okay. 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 Now, Byrne says, yeah, but the longer you trade, the bigger the risk it goes against you. Your thesis may not always come true. That is true. This is why we use technical analysis. Also, this is why it's important to understand business cycles and seasonal cycles. Okay? So, for example, why did I say 12 weeks? So let's just pick on this. Okay? Let's say I'm buying CAD now. Okay? My goal is to buy CAD. Okay? I will exit June 1st. So I'm not saying indefinitely. I'm not saying buy and hold forever. Okay? That might be my investment thesis. And of course, it takes some research to confirm or deny this. So that's your decision-making process. And you can do it whatever way you want. Reading the tea leaves. It doesn't matter to me. Okay? Hey, Thiago's giving away my secret sauce. Shh. Okay? So anyway, so there's a logic here. The important thing is you have a logic. And now I'm looking at every trade here through the lens of my thesis. There's a lot of traders that do this. They're like, I think it's going to go there, and then I think it's going to go there. So it might do this, it might do that, it might do this, it might do that, and then I'm worried about this, and right? And there's really lack of clarity. Instead, if I show up to the game here, I'm going to call this a game. It's a game of logic. It's a game of probabilities. Okay? Okay, like if you learn programming, for example, you learn how to do a decision tree. That's part of game theory. Game theory does decision trees too. And then if you take a class of statistics, you'll learn probabilities, confidence levels, okay, deviations from your confidence, right? So there's a lot of things. So study statistics, programming, and game theory. Okay? So anyway, so I show up to this game. Now it's just a game. And I'm like, all right, I'm a buyer of CAD. Okay? Right now the game is somewhat neutral and even favorable to my adversary, because we still have this going on, and this is a new part of the game. So now I'm entering the game. Okay, and I want to sell this. Now, there's a challenge here. I see it. My adversary's in the way, but my idea now is to sell here or sell here. And I got to go small moves because I don't have the probability yet. So now you do if-then statements. So if it does this, then, right, they're going to counter move. What's their counter move? They'll take it up depending on which resistance we have broken or not broken. And their counter move would be up, in which we would sell there or there for the next down. Okay, and I'm making decision trees. But if it goes up here, I think my next move is going to get caught in neutrality. So I got to be cognizant of that. Now, if I get the lower low, lower high here because of this lower low and the breach of this, and right, then my confidence level is higher. Maybe I have a bigger stop or lot size here. Or maybe I more aggressively enter here because now I know I have what in my thesis. Well, my thesis fundamentally is this is down for whatever reason. I read the tea leaves in my, right? But I see that as lower high, and then the future lower high. And so I'm really taking this down. Okay. And I see the counter moves of my adversary. But I'm playing it like this now through the lens of I'm buying CAD. Now, if you want to increase the probability of this trade, you would also analyze Kiwi and see, is it truly weak? There may be something weaker. So you might spend at least, let's say, an hour, let's say, analyzing all the Kiwi charts and find out, is there something weaker than Kiwi? Let's say, for example, Aussie. Let's say Aussie was weaker than Kiwi. You just look at Aussie Kiwi and you're like, well, it's kind of the same trade, but so you want to analyze the two and say, well, for whatever reason, Aussie is weaker than Kiwi. So CAD will perform better versus Aussie. And you can try to tweak the game by changing the opponent, if you will. But what I think is scary is most new traders, they walk into their charts and they just trade the same thing for this whatever reason. And they have very little idea of up or down. And they do things like, I'm going to use the London breakout strategy, right? And they're just reacting to something that's already has happened in order to maybe pick up some crumbs. But then you're like, well, why did you do it? And their answer is, it made a lower low. Oh my God. Okay. Much different play. So one of the things I thought I'd work on, even though I don't have any time in the day, it's amazing. But one of the things I was thinking about is building a model for an entire seasonal portfolio. Oh boy, that would be interesting. I think I'm going to do it just as sort of a hobby. I have a general idea of what I want to do every year, like a pretty good idea, but I never thought about if I analyzed every single pair, starting by making my own indices and creating a seasonal structure to indices, and then maybe combining those indices, combining those and then trying to pick out and actually write these things down. Wouldn't it be interesting if I said, I'll just pick on this one since I'm looking at it. What if I said in the model, every March, and I'm not saying this is true, so don't write this down as a rule. I'm not saying it. I'm trying to give the idea of what a model is. What if through analysis, I found most Marches, I want to sell this. And I write it down in the model. So almost like an algorithm. Could you imagine? You have this algo that says, in March, look to sell this. And the algo is where's resistance? The algo looks at these levels of resistance. And it's ignoring it. It's why? It's February. And then we hit March and the algorithm is now saying, okay, it's March, look to sell a change of price, right, at a level of resistance. And it's is that resistance? No. Is that resistance? No. Is that resistance? Yes, but not a change of price. Is this resistance? Yes. There's the lower low. So it becomes a change in price right here. Let's do this in green. Lower low, lower high, it sells. And then the model says, stay short till June. but you had that for 50 pairs. Wouldn't that be interesting? Yeah, sure. But the thing is, do you know how much work it would take to be able to make that call? That's the thing. It would take so much work. You're going to need the data and probably a data scientist, like a programmer that can put all this together, but it'd be interesting. I think it'd be interesting. Okay. Now you're saying it would be awesome. My point here is that that's not the better way, but I'm trying to get you to think differently than just logging in and be a pure tactician only. Okay? So while this was rising, and I explained this on Sunday night, okay? Well, first of all, I skipped this one because of the gap, and I explained why, because I'm risk averse. As I told you, I'm probably more risk averse than you are. Okay? And that, but as this was rising, I was already thinking of lower high, but not technically. Okay. Well, it's not necessarily fundamental, Pokwana. Okay. So we can define that somehow differently. So fundamentals, okay, that's where people are watching things like CPI for inflation, GDP for growth, okay, and let's say jobs for the economy. Why do we care about this stuff? Because the trend in this, and trend in this could lead to a change in monetary policy. Monetary policy. Well, we trade money. Monetary. We trade the money policy. Okay? Of that economy. That's what we trade. Okay? A big part of all of this, so like if you pull apart GDP, C plus I plus G. If that's what we had, which is called a closed economy, currency values never change. Currency value would never change. Okay, the monetary policy inside of there would create inflation, and to the people, the price changes, right? But not the value, because nobody's buying your currency, right? So what we need to add to this is plus, and I'll change the color to highlight it. Okay. Exports minus imports. That's how much stuff we buy from foreigners and how much stuff foreigners buy from us. Okay? So when we import, okay, let's call this M is equal to, okay, the export of domestic money. Okay, so if you buy a Samsung phone, you're importing the phone and exporting US dollars. If you live in America, you export your US dollars into the interbanking system. So now there's more dollars in the interbanking system, but you converted it to South Korean won to pay Samsung for the phone. So now there's less yuan and more dollars. So you exported the dollars. The value of the dollar fell. So you sold your dollar and you bought a Korean phone. You understand that? Every time you go to Walmart, you're selling your dollar. Because most stuff in Walmart is not from the United States. Now, I bought a Wagyu ribeye. I went to Walmart the other day. It's always a very exciting thing for me. I'm like, oh my God, I get to go to a Walmart. So I went to a Walmart and I bought a Wagyu ribeye steak. And it was pretty good, but it's much thinner. And I thought about it. What's probably happening is there's a ranch somewhere that produces these Wagyu steaks, and nobody wants to buy the thin ones. Right? Why would you want a thin Wagyu? You want a big, thick Wagyu, right? So anyways, so the ones that people don't buy, they just package them, sell them at Walmart, and you're like, dude, look at this, $25, you can buy a ribeye steak, it's Wagyu. Yeah, but it's super thin. But anyway, so I bought one and all that kind of stuff. So I got excited. In that case, I didn't sell the dollar. I exchanged the dollar for a Wagyu ribeye, and the rancher, being in America, got US dollars. So the value of the dollar didn't change. Okay. I was thinking, what did my wife buy? Maybe she bought something that sold a dollar. But anyways, if you buy, let's say, clothes or electronics, you're actually exchanging your dollar for a foreign currency for a good, and therefore you're actually selling the US dollar. And you're very un-American. Well, yeah, but when you do that, inflation falls. Okay, think about it. Okay, wheat and beef prices are up, right? Wheat and beef prices are up. That's a domestic issue. So if you only buy domestically, you will have inflation. Your prices will be higher. So now that Russia's cut off from the world, they will be crushed by inflation. The same way, let's pick on Central America here. Honduras, El Salvador, basically isolated from the rest of the world. Unfortunately, socialism back in the 60s and 70s crushed their economies and they've never recovered. Okay. So anyways, they buy and sell stuff basically domestically and do very little with other countries. Okay. So prices are high. Now, if you are involved in the interbanking, in the global economy, why does the United States buy from China? Why are Nike shoes made in Vietnam? Because they can do it cheaper. So an American might pay more for wheat and beef, but might get electronics and clothing for cheaper. And of course, cheaper is disinflationary. So the more you trade with others, the better off you are. So in your first year of Economics 101, right, Ashish gets right to it, through specialization in trade, okay, Economy 1, okay, you're almost certainly going to get this. Economy 1 focuses on making bicycles. Okay. Economy 2, okay, makes radios. Now, each economy can make both bikes and radios, but they decided Economy 1 will focus on bikes, Economy 2 will focus on radios. Because of that, through things like economy, right? Right, of scale, economies of scale, economies of scale, which that means like economy 2 buys more and more and more of the input resources required to make radios. So they have to buy more gold, more copper, more stainless steel, and more plastic for radios, because all those are input resources needed to make a radio. But because they make way more radios, because that's what they specialize in, they're at the very least, they're able to negotiate better prices with the suppliers of that raw material. They buy more, so they get a better deal. So at least their input costs are cheaper. But also, every factory in the country is making radios. They have the best technology and the best skills and the best entrepreneurial ideas on how to make radios cheaper, faster, better. So they make a lot of damn radios, and they're good. So they trade those radios because this economy needs radios. But they do the same. They get better deals on the input costs. They have better research and development. They have better factories. They have better machines. They have better educated people on making bicycles, right? I'm the 5th generation bicycle maker, right? My great-great-great-great-granddaddy made bicycles, and now I make bicycles. Bicycles are in my blood. I have a love and a passion for bicycles. Sweet. What happens? Economy 2 gets more bicycles, and Economy 1 gets more radios, and all of it's done cheaper. Lovely, tell you, Mum. Okay. Now, Burns says, hey, would you look at other variables in economics, like the oil industry and seasonality for that? Yeah, I covered that in my day trading group on Sunday. I covered the seasonality of the oil complex and how to play it through currency trading. Wicked smart, right? Yeah, baby. Yeah. Old news. Old news. But speaking about oil, guess who's meeting today? Yup. OPEC plus, but you might as well kill that because it ain't Russia. So anyways, OPEC's meeting, huh? Do you think the Saudis feel bad they're making all this money? Hey, man, they're still looking back 3 years ago when oil was free. Okay? It sucks. Do you know how much that sucked? The Saudi princes had to live on the same $250 million yacht for 3 years in a row. Oh my God. Okay? Thankfully, now that oil prices are up, they can buy a $400 million yacht and get rid of the old pathetic one. It's worn in. The carpets are dirty. You know what you do when you have a $250 million yacht and the carpet gets dirty? Buy a new yacht. You can just see it, right? You're throwing a party on your $250 million yacht, and one of the women spills red wine on the carpet. You're like, well, guess I got to get a new yacht. So, yeah, how excited are they going to be about cutting prices? Or, so maybe... maybe they will. Geopolitically, maybe now they feel like they have to. Okay. And so Bernd, again, a previous comment that Bernd made was, the longer you hold, the more it risks going against you. But that's what technical analysis is teaching you, right? So lower high, lower low, lower high, lower low, lower high, okay, lower low. And you stay with that until that stops. But you have to understand, guys, trading Forex isn't magical. It's not random. It's not manipulated. When people tell you it's random, when people tell you it's unpredictable, when they tell you it's manipulated, what they're actually saying is they don't understand. And I love the example, and I kind of hinted toward it earlier, so let me clarify myself. When the shaman comes out of his tent, and he's got bones all around his neck, and he's got the black makeup over his eyes so he looks like a skull. Okay, and he's got the big stick with the rattle on the top, and he comes out and he slams the stick down on the ground, and everyone gets around him, and he goes, woo, 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 woo. He's like, give me gold and wine and virgins, or I will make the sun disappear. And he shakes his rattle and everything. And they're like, what a crazy old man. And then sure enough, right? The moon crosses in front of the sun and it goes dark in the middle of the day. And they're like, oh, shit. He has magical powers. Give him gold, give him wine, give him virgins. And he happily goes back into his tent and resubscribes to the Farmer's Almanac. He's like, best money ever spent. Virgins, put the gold over here. Thank you. And pour me a glass of wine, please. Yes. And you're like, yes. Okay. Yes. Well, how valuable is that subscription to the Farmer's Almanac, which tells you the schedule of solar and lunar eclipses? It's pretty gosh darn good, huh? So it's only magic if you don't know. Okay? And if you don't have a reasonable idea or identified by a thesis and a strategic plan, then honestly, you shouldn't be trading, because you're simply a liquidity event for a professional trader. Okay? I think I got to go now. Hang on. Yeah, I got some meetings today. Yeah, I probably have to go. What to make a post in the swing trading methodology with the link to a position calculator and risk. Do you think you need it? A position calculator? I mean, why don't we talk about it first? But so yeah, maybe it's a basis for discussion. Okay, so yeah, I guess I'll pull the plug. Did you find today's conversation interesting? Yeah. Okay. So I'm trying to add bigger value than, let's say, all my fellow Forex streamers. Okay. But the idea, though, is I think they have a different audience. And I'm treating you, I think I treat you with more respect. This idea that we can have like an open conversation, I can challenge you to think differently. If you're only interested in me saying, oh, look, the MACD crossed over. Now everybody buy, buy, buy. Like if that's what you want, I'm sorry, son. That's not me. Okay. But I will treat you like an adult, and I will treat you like someone with a professional attitude. Even if you don't intend to trade other people's money, you still think about trading like a profession and not like a get rich quick thing. Because that get rich quick is only, that's a sign of poverty. If anyone pitches you something like that, that means they don't have any money. Okay? Nothing like scaring off a rich person by pitching them a way to get rich quick. They can smell it from a mile away. So anyways, peace on earth. May the pips be with you. May our profits be above average. And by the way, to the people in my day trading group, yes, we meet at 7. I'll probably be rolling in like back. I have some meetings today, and I'll probably get back just in time to jump on the mic. If I'm a half an hour late, I mean, if you can't and you don't want to, that's cool. There's a slight chance I'll be a little bit late, but I hope not, and I don't think so, but it could happen. But I'm like packed and stacked today with meetings. So everybody pray for my cat and my Aussie, and then I'll see you in the evening. Okay. So just for everybody to know, our day trading group meets 10 times a week, twice a day. And our swing trading group meets every Thursday to plan 1, 2, 3 weeks in advance. That's what we do. Cool, right? Please click like. That just happened.